Thank you very much, Ambassador. I'd like to thank very warmly the organizers of this event, the Greek alumni of the London Business School and the Stanford Club of Greece. As you can see in your program, the first stream of this conference involves banking, which is an issue that has long bedeviled both the Greek economy, but also the European and the US economy, especially since 2007, 2008. We have here with us on the panel some of the top experts in the world on these issues. And we were very fortunate at my newspaper, Kathimerini, to host them in our pages recently. We're slightly behind schedule, so without further ado, I will begin by introducing Professor Anat Admati, who is a professor of finance and economics at Stanford at the Graduate School of Business, and is also the co-author of a book called The Banker's New Clothes from a couple of years ago, which offers some very strong criticism of received and conventional wisdom of what it takes to make the banking system safe. So, Professor, please take the stand.
Thank you. I really thank Christos and Panos and all the organizers for all this work that they did for this conference, which looks great. I've had a great time so far, and I look forward to the rest of it. So I come from Silicon Valley, where there is a lot of going on, and it does not involve much debt. But when it comes to the banking system, especially in Europe, when it comes to Greece, debt is a key word. So I think sort of a little tutorial about the politics and economics of debt might help us get started here. So that's what I plan to do quickly, and that I hope will shape the discussion. So everybody borrows, and I'm excluding governments here, but I'm making a distinction between households that borrow, and we've already discussed credit. Households need credit, just right, not too much and not too little. And you already have a sort of a balance sheet structure here, which is what you do with the money, what are your sources of funding, debt being one of them, debt being colored red in this presentation. So households borrow through mortgages, credit cards, take loans, and otherwise they live off their wages, pensions, etc. Then you have non-bank corporations, and I made a distinction between them and banks because banks kind of come into this world with a lot of debt already in place, which is from depositors walking in and giving them money. And all corporations have owners and shareholders as well. And what they do with that money, of course, non-bank corporations invest in all their businesses, whatever they have is their business. And for banks, the business partly involved, or maybe mostly involved, giving loans. So that's where the households often borrow. Here's the thing about debt, that just to kind of fix ideas here, debt is a promise. That is a legal promise, an IOU. And so you just have to pause about that. We take it for granted, but there is a certain thing that comes along with that, which is why it has to do with courts and other things like that, and what happens if it's not paid, or what to do if it's an NPL or whatever. And so I'm going to show you how debt creates risk, magnifies risk, and it must be paid or restructured, or there's a default. Obvious things I'm saying here. The point about debt is the overhang and what it does while it's there. And the overhang is a big problem that we now live with. And so that's the challenge. And then the challenge is how to manage the overhangs that exist and how to avoid overhangs in the future. The thing about the overhang is that it's very inefficient and distortive. And so it changes the borrower's decisions, it changes the borrower's ability to invest, and debt has an addictive kind of feature. So that in high dosages can be kind of reinforcing. And that's a problem in banking in particular, because when it comes with a lot of debt immediately, and then you put on top of it guarantees and deposit insurance and other things, that feeds that addiction. And that's something that policy needs to counter, because the markets are not. So here is a very quick introduction to borrowing, made on a mortgage, color-coded for debt and equity. Here is our borrower, Kate. She borrows a lot of money so she can buy a house. And she puts a little bit of down payment, and therefore she can buy a big house, which is a wonderful thing about debt, that you can buy a house or invest in whatever. But let's trace Kate's investment here. It's in dollars. If the house goes up by a little bit, Kate makes 50% on her down payment. So the debt looks wonderful as it magnifies the returns on the upside. The house goes up just by 5%, she doubled her investment, which is a wonderful thing. And if it just goes up by 10%, she tripled her investment. So the leverage worked really nicely on the upside. However, there is a little bit of a problem on the downside, which is that when she has 5% in the house, she can easily get wiped out. And so, for example, a small drop would wipe out her equity, and a larger drop will put her underwater, which means something like an insolvency, an inability to pay. If she sold the house, she couldn't pay her mortgage. That's insolvency. That's NPLs. That's what happens on the downside of this wonderful debt. Now banks, as I said, start with deposits, red deposit. They seem to kind of forget sometimes. The CEO of my bank recently forgot that he owes me the money. So you just need to remind them that's colored red. They do owe that money. But it feels to them a little bit like a play money. In any case, we want them to lend it, and we want them to take risk with it to a point. And so they might lose as well when there's an NPL, for example. So we do want them to be able to absorb that, so we put a little bit of equity money underneath that. Of course, the depositors expect to be paid, and other people, everybody expects to be paid, everybody hopes to be paid. But what happens if a bank loses? Well, this is what can happen when a bank loses, because the banks tend to, this is Stanford animation help, to show contagion and crisis and systemic risk. And I have Uncle Sam here, because this is kind of was made for US TEDx talk that I gave. And so that's what happens. There are very many mechanisms of contagion in banking, which just means that banks tend to fail at the same time, take each other down, all kinds of ways in which when one of them fails, they all tend to fail. And that's very destructive for the economy. Even one bank failing is a disruption, but certainly a lot of banks failing at the same time is a big disruption. And if it happens very suddenly and there are runs, then you need to send very big ambulances like we are seeing. So the color code here for this company in my part of the world is quite striking. There are many companies that don't borrow at all. And so you see the big distinction. And even other companies, without any regulations, don't borrow as much as banks. Or the question is, they have a lot of equity, which banks also can have, even though they have deposits and other debt that's playing a purpose in the payment system and stuff. So the question is, why the stark difference between the teeny amount of equity that banks have and the comfortable levels of equity that other companies have, especially because banks actually tend to have collateral harm when they run into distress. Here's, by the way, a British bank, British-based bank, before the financial crisis. You see Barclays here from '82 to 2007, and you see the size of Barclays and the funding sources of Barclays. The yellow is deposits, the green is money market funding from money market funds to the banks. The red is other debt, and you see a little sliver at the top. That's the equity. Would you say this bank was not quite prepared to absorb a lot of losses in the crisis? I'd say so. And so that's what happened. Other banks were just as badly. And the regulations sort of allowed that. So here is a simple solution for this. Why shouldn't banks have more equity? Now watch my little Pac-Man eat some of the profits. So of course I need to, who puts the number on a balance sheet, you can see again how there's some loss. okay? There's a loss. Whether you recognize it or not is another question, but there was a loss. And now, of course, equity got chewed up fast, as we saw. And should there be more loss, now you're kind of talking about insolvency, and maybe there's some suspicion of insolvency, but if you see my better capitalized bank with more equity, it's still around, it is not insolvent, it can continue to lend, or everything is much better there. It doesn't need bailouts or anything. Now you can now look at the symptoms of a zombie bank, or any zombie borrower for that matter, the insolvent borrower. The symptoms of insolvency, you can sort of view me as a corporate doctor saying, you know, what do you see when you see it? Forget kind of capital ratios you can float. I'll say something about that. I'm not impressed. I'm looking at symptoms. Symptoms of insolvency or of heavy distress, of heavy indebtedness, include that you absolutely hate or you can't raise any more equity. So you just want to take money out. That's the symptoms of a borrower who just ahead of potential default, or because they don't want to give a gift of safety to the creditor, just want to take the money out and protect from the creditor, wants to take risk, otherwise they won't invest. All the distortions that happen with heavy borrowing is in fact the reason that most companies don't go there. The creditors will begin to breathe down their necks. That's the difference with banking, because banks have very easy creditors, like depositors, who are not breathing down their necks, who are just, as long as they're safe, they just want to go about their business. So there are lots of symptoms that go with this zombieism. It says don't open debt inside. That includes wanting to hide your insolvency and not recognizing NPLs and all of that, and not settling the loans. And that happened both in the US and it's happening in other countries, and we'll talk about this a little bit more later. Now you can bail out banks. The problem with bailouts and a lot of supports that banks get is that they don't actually relieve the indebtedness. They come in the form of more debt. You prevent defaults, but they're still with the overhang. Now it's an overhang to the central bank or it's an overhang to the government, it's still an overhang. So they still can't quite function very well with that overhang. So why don't they like equity? Because they view it as expensive. And the question is, who is it expensive for exactly and why? And is that the right thing? And if it's so expensive, equity markets are the same, equity investors are the same, why is that, does that not apply to other companies? Why do they have so much equity? Are they being stupid? That's the question. So here is the fundamental physics of it. Okay, and I'll try to go faster to the other slides. Somebody is going to have to absorb losses. Somebody. That's the harsh reality when there's risk taken. And if there's not enough to pay the debts, then you have to look for somebody to absorb it. It can't be depositors because, God forbid, depositors have to be insured at least to an amount. It can't be secured creditors. They have collaterals. Depositors actually don't. So it's a very strange thing where you have these very passive creditors who have no collaterals who are expecting to be paid. And then on top of them, you can use the assets to collateralize and get more. And then what's left? There are unsecured creditors that are not deposits, and they're shareholders, and then there is the rest of the public. So from the banker's perspective, it's best to remain highly indebted. There are all the incentives there. There's a certain addiction to borrowing, which means that you don't want to, once you're highly leveraged, you don't want to recapitalize voluntarily, and that's true for all indebted companies, unless they have covenants or something to stop that, or regulation. There are tax subsidies that we stupidly give to debt over equity. And there are all these guarantees, and then there is the return on equity-based compensation that encourages also borrowing. That's from the banker's perspective. From society's perspective, whatever makes it costly for banks is because they can shift some of the costs to other people. So from society's perspective, if they pay less taxes, somebody else has to pay more. So there's not a social cost in the fact that you're saying, well, I'm going to make you work in markets, fund in markets, and then you can make the loans with equity-funded money. Here is the bank, and it can fund loans with equity or debt. Here's the river of the financial system or the economy. The more debt, the more systemic risk. You subsidize debt, you get a lot of debt, a little bit of equity, and a lot of systemic risk. The banks might pass some of these subsidies to other people, but there's not a lot of evidence actually that they do that. What happens is actually lending gets distorted. You have booms and busts, too much and too little, all kinds of problems. So equity in banking has declined dramatically, just as over the years we put more and more safety nets. So as we put more safety nets, we forgot to counter the incentives that come along with that. So whereas banks used to be partnerships with 50% equity and unlimited liability, banks have become limited liability corporations with almost no equity, and somehow they can persist in this way. So a safer bank will just have more of this green stuff. How to get there is another question, but there's absolutely no reason why not. We have regulations. The regulations are very, very complex, and I certainly don't have time to go through all of this. I bold-faced one number for you, but you can see the headline numbers are all in the single digits, and they're not even relative to total assets, not to mention off-balance sheet liabilities. 3% equity, which is our safeguard, is not anything that companies ever live on without any regulation. There's just no reason that the ones we really need to be there in a stable way should live like that. We got somehow confused into thinking that's okay. And we didn't even learn from the way the regulations were constructed and all of that how to do it. Is it tough? Martin Wolf has one of the great lines on that. If you triple it almost zero, you don't get a large number. So whenever they say it's so much more than before, you have to remember that before it was virtually zero. So 0 times whatever is still 0. Last time I did my math. How much? Until the risk is basically borne by somebody on that balance sheet and not outside that balance sheet. Meaning, ideally, the people who get the upside should be the ones bearing the downside. Then they will have better incentives to manage risk as well. So with other academics, I organized a letter back when Basel III came out. And we just didn't want to sound too crazy by saying 20% or 25% relative to the 3% of Basel, so we just said at least 15% of total non-weighted assets, and there's always an issue how you measure it, would begin to get to the right, you're not in the right range, you don't have enough digits in your requirement, something very dangerous going on, and we went on. This was meant to be an op-ed and an open letter to G20, but it was just a letter because the next day a bank CEO had to have an op-ed to say something else. So this is from Andy Heldine's papers saying that capital ratios, the way they're calculated, are not telling you much. If you look on the left side, this is capital ratios, regulatory ratios. Red is the banks that got into a lot of trouble. Blue is the banks that didn't need as much support. And you see that they looked great through the crisis. This goes to Lehman bankruptcy. And so you wouldn't know there was a crisis on these. These are market-based ratios on the other side, and on them you see more. So the regulatory ratios are just not going to give you the warning. And this is another huge mistake there. Risk weights, especially zero risk weights. So how did all this lending to Greece happen and AAA mortgage-backed securities? Because they were assumed to be riskless for the regulation. So a bank with this kind of capital structure can lose, but it's considered well capitalized because all this Greek debt is just ignored, gets a weight of 0 in their calculation of capital ratios, which is of course ridiculous when the debt is actually risky and in fact did default or did do a restructure. And the same happened with AAA securities or that were mortgage-based. So we are very bold in our book, and I haven't heard in 8 years of asking this question, why not? Why not? We can talk about transition and all of that. Why not 25%? Why not let it ask for 30 and let it go down to 20 because it has to absorb losses and build it back up and stay safe and sound, and you know your measurement issues are less pressing and you're not on the edge all the time, and why not? Like it was 100 years ago before we had safety net. Why not? The key is to have prompt corrective action. The key is to act for the regulators as if they were covenant writers for unsecured creditors, to step in where the markets fail. You'll see if you're zombie symptoms if you started doing that, okay? And the worst disconnect between what we see And what people say is that these banks that are incredibly sick are taking out dividends. Whose money is that profits? Why are banks allowed to pay dividends when they can easily make loans with that money? That's perfectly good equity money that they just pay out in order to continue borrowing and stay indebted. So the bad news is that regulatory reform throughout the developed world is an unfocused, complex mess. There's a lot of complicated stuff instead of simple stuff, and quite clearly something remains wrong, which we can go on about too weak to fail and all kinds of things like that. And Mervyn King, governor of the Bank of England, in his recent book, just said without reform, and he meant much more radical reform than what I'm saying, another crisis is certain. This is Greece now. If you look at the Greek government bonds and you ask yourself, why did Greece borrow so much? You have to ask yourself, who made those loans and what were their incentives and how did it work out for them? Well, the people who made those loans were people working in banks in the rest of Europe. A lot of these loans were made by Swiss banks, by French banks, by German banks. In 2010, French banks held 40% of Greek government debt. And that's why Greece couldn't restructure its debt in 2010. That story is not told frequently in Germany and France. Swiss banks abruptly exited in 2009. That's the blue here. And this is who owned Greek banks' debt, Greek government debt. Over these years from 2007, the yellow or mustard color is French banks. The green is German banks. What you see is that they exited, but they were given a lot of time to exit. Meanwhile, Greece was supposedly bailed out, which was a backdoor bailout of these banks, only to spread this bad debt across Europe's citizens, mostly, and IMF and ECB. So when you look at where the debt is right now, what you see is that France in particular has reduced its exposure to Greek government debt from a lot to, to very little to its citizens, only through bailouts funds. Germany still has exposure, but not its banks very much. Swiss is out of there, et cetera, et cetera. So the critical creditors now are official creditors who absolutely hate to lose, as you know, and now they can be very strong, our creditors, and they can demand all kinds of things because they're very strong politically, and that's become the problem. But what they're not telling their citizens is that they took on debt that they allowed their banks to make without creditworthiness analysis, without worrying about the risk, without being ready to absorb those losses by the ones who took them. So nowadays you can see who owns Greek government debt, and that's sort of what is a legacy debt and an overhang for the government of Greece. Given, I didn't include them because governments are more complicated, including with its resources, their taxing ability, their commitments to pensions and all these other things that they are indebted to, or their ability to sort of raise funds without owing a lot and having a lot of overhang so they can invest. So extend and pretend is common throughout the system. Zombie borrowers tend to be dysfunctional. They tend to behave in a very inefficient way all throughout the system, and letting zombies survive is not good policy. That's kicking cans down the road, and you really have to face reality when you have bad loans. Everybody, the people who made loans to businesses, the people who made loans to governments or corporations. So you have to do that. Extending and pretending delays essential reforms, prolongs recessions and harm, increases the eventual cost. So it's just kicking the can and then paying more. And everybody's horizon is just way too short, and that's kind of the problem. So the big obstacle is a combination of politics and confusion, and that's sort of what our book is about, to try to clear the confusion so we can have a discussion of these issues, of how do we at least keep certain corporations in this world healthy and safe so they can do their job, they can not get too bloated, too reckless, too dangerous, which is what banking industry remains, unfortunately, the banking sector. Extracting rents from the rest of the economy and not serving properly what it can serve. So banks and governments have very complex relationships, and that's part of the reason banks and governments have symbiotic relationships, and I probably should quit. But the banks lend to governments, governments regulate banks. They have a lot of bargains that they make, politicians and bankers, and that's basically becomes a problem for the rest of us. I should go, right? So here comes the nonsense. There's a lot of confusion about what words mean here. Here's the headline in the paper. You might think the word capital, I only talked about equity. You might not know what this word means. You might think it's something they have to hold in a reserve, in a safe deposit box, a rainy day fund. And here's a Telegraph newspaper telling people that what they have to hold is cash. That's just false. This was not what this news was about. It was about the US requiring 5% equity. Funding can be used for things. It's not a pile of cash, it's not a rainy day fund, it's on the funding side of the balance sheet, it's unborrowed money is what it is. And then the lobbyists love this confusion because they can say that if you force them to hold capital, then they keep money out of the economy, which is complete and utter nonsense. But they keep saying it, and the newspapers keep quoting it. These are pictures I took on my way here. I marvel at aviation. I absolutely marvel at the fact that we can go on an airplane, not think twice about it, and get to the place where we need to go. It's quite complicated to get this machine up in the sky and get it to the right place without crashing into anything. So you wonder how come aviation is safe and banking is not? Is banking so much more complicated than it? Here's one of the differences. When the plane crashes, you see it on TV, and you have a black box, and everybody involved will know, and they'll know who's, most of the time, almost all the time, they'll know whose fault it is, and there's no spin and no narrative about this. It was a fog, it was a bird, it was something else. Here there's just spin and narratives in banking. It's unbelievable. Spin and narratives. Oh, we did so much, it's complicated, it's too costly, they'll be intended at level playing field, on, and I don't have time. I have collections of flawed claims. We call them bankers' new clothes because they have as much substance as in the story of the emperor's new clothes, etc., etc. So here we have a very fragile system, very unstable system, touch it and oh my God, gotta rush in with the ambulances. Stories get told about how stuff happened and we had courage to act and all this other stuff. And I've written a lot about this. I have a couple more slides that I was sure I won't get to, but if we need, I'll go to. And there's a lot of materials posted both on the book website and on the Stanford website. If you search under excessive leverage and risk, there's writing by a few Stanford colleagues and I. And actually in the Stanford upcoming alumni magazine, there's a story on a paper on the addiction to borrowing of all corporations, on sort of borrowing becoming addictive for corporations. Thank you.